Over the last week or two, I've been getting a lot of questions on Vethor, and a lot of people have been asking me about Vethor and whether I think that it's a good investment and whether I think that it's even worthwhile to look into in more detail. And so this video is aimed at providing a brief overview of everything that you need to know about Vethor. So first of all, Vethor is a currency native to the VeChain platform, which is designed to act as a medium of exchange used to pay for VeChain services by customers. And this means that Vethor is a little bit different to many other currencies in that Vethor doesn't have a fixed supply. And it's not only that the supply may increase over time, but it may actually decrease as well. And that's because there are two factors which have an influence upon the circulating supply of Vethor. And they are quite simply the amount of new Vethor that comes onto the market each month through Vethor dividend, and secondly the amount of Vethor consumed and effectively destroyed through genuine use. And there is one big thing that will determine to an almost absolute extent the future value of Vethor, and that is how VeChain decide to approach the issue of increasing levels of use and transaction volume and therefore the demand for Vethor over time. And hey, if you're enjoying this video so far, I want to ask you to help me out with a small favor in return. And that is to subscribe to our channel and help me to continue to grow and continue to spend more time researching and making videos like this, and I really do appreciate your support. So anyway, you see VeChain have to make a decision, because as the demand for their services continues to increase over time, the demand for Vethor to pay for those services will also increase as well, and that means VeChain have two options. The first is that they do not alter the Vethor dividend rate in any way, and therefore they allow the value of Vethor to increase over time as the increasing levels of demand for Vethor are met by a stable and non-changing supply, which of course then creates an excess demand and causes a price to rise, and VeChain could reduce the prices of their services in Vethor terms to make sure that the real prices do not actually change. So if the demand for Vethor were to let's say double over the period of a year and the supply was kept the same, meaning that the price of Vethor were also to double, VeChain could then reduce the prices of their services in Vethor terms by half to make sure that the real prices do not change. Now the other option that VeChain have is to increase the supply of Vethor through the dividend in line with increases in demand, which means that the market price would remain pretty much the same at all times and would only really change when investor demand changed. And whichever option VeChain choose to follow will depend upon what VeChain want to happen and what types of behavior they want to incentivize or disincentivize. For example, if VeChain wanted the companies who are using their services to own VET, then they would likely make sure that the value of Vethor increases over time by keeping the dividend the same. Because if the supply of Vethor to the market remains the same into the future, the prices will rise. And the companies using VeChain, and more to the point the people running those companies, will know this as well. And instead of waiting for the prices of Vethor to rise and then paying more in the future, they would either stock up on Vethor right now to avoid increasing prices in the future, or they would buy VET and simply use the Vethor dividends to pay for the services which they use. Now on the other hand, if VeChain do not want the companies who are using their services to own VET and instead buy Vethor as and when they need it on a kind of pay-as-you-go basis, then they would likely commit to increasing the price of Vethor in line with the demand to make sure that the prices remain the same over time, and to give those companies an assurance that they do not need to worry about excessive price rises making Vethor more expensive for them to buy. In my opinion, the way that I have made sure that I capture the value of the growth in the VeChain platform is by owning VET instead of owning Vethor, as in either case VET will grow with the VeChain platform regardless of whether VeChain decide to distribute more units at a lower price or less units at a higher price through the dividend. And the truth is, nobody knows exactly what VeChain's policy toward their Vethor dividend will be over time. And I think that by owning VET, an investor is eliminating their exposure to a situation where VeChain decide to make sure that the market value of Vethor is steady and does not rise over time. But then again, Vethor does have a much lower market capitalization than VET, and therefore the potential for large increases in market value in short periods of time is much higher, and would require far less investment capital than an equivalent gain in VET would. And so I think that VET is likely to be more stable and offer a lower risk option, whereas Vethor presents a little bit more risk because of the unknown factors involved, but it could also produce large gains far more easily. And I suppose that it really depends upon the individual investor's position and their investment style, and also what they are looking to get out of crypto. Because I was a fairly early investor into VET and ADA, I'm now working with quite a large amount of capital, and so my personal strategy is built around trying to minimize risk, even if that means forgoing potential gains, and that's why the only Vethor that I own right now is generated by my VET dividend, and I personally do not invest into Vethor. But maybe if I were starting out and working with less capital and I could afford to take more risk, I definitely would consider investing into Vethor. But then again, that's just my personal opinion, and let me know what you think in the comment section below. Thanks for watching.